Most annuities, when they're put together, are put together to provide a very specific service. The services that they are put together to provide can vary from annuity to annuity. Unfortunately, most often when they're sold, they're not sold for that specific protection. They're sold as a comprehensive investment product, something an investor can buy and it'll cover everything they need in their investment portfolio, when in fact, it's impossible for them to do that. The reason for that is very simple: the cost structure inside the annuity. Because you're buying an annuity for protection of some event, the insurance company has to charge you for that protection. That high cost gets in the way of the market helping it achieve its goal. So let me try to explain that a little differently. A new client walks in the door with a portfolio of annuities. Their statement usually to us is something to the effect of, I have this investment, but I don't seem to be making any money. Why is that? And what we find out is that the annuity has a cost structure somewhere in the neighborhood of 4 to 5% fees associated with that annuity. When you have a stock market and a bond market that historically in a balanced portfolio are going to return somewhere in the neighborhood of 7%, those fees do not leave a lot of room for growth. So when annuities were originally created, what you were buying from the insurance company was a cash flow stream that's guaranteed for your life. You gave them a certain amount of money and they promised you that for as long as you're alive, they're going to give you a certain amount back each and every month. But annuities over the course of the last 20 years have really transitioned away from that. Those are still out there, and those are very valuable products, and clients should look at those when they need to have a guaranteed fixed income stream. And we do help our clients look at those. However, where the annuity is misused is when it's sold as being a comprehensive investment product. However, it has too high a cost. You know, an annuity is an insurance contract, right? You give your money to an insurance company, and they're going to invest that money for you in a portfolio. But they're also going to do something else with that. They have to, by law, provide you with an insurance product as part of that contract. The question is, what are you insuring when you buy that? In days past, 20 years ago, the insurance was simple. If you die, we'll make sure you get your money back. Nowadays, what you're buying has become way more complicated. You may be buying some fixed annuity stream, some fixed payment at some point in the future, if and only if the market does certain things, right? If the market doesn't perform how it's supposed to perform, right? Unfortunately, for an average investor, they're gonna far exceed the cash payments they're gonna get by not investing in the annuity than they are by taking the guarantee that the annuity company is offering. So quite often when we explain the cost structure of an annuity to our client, they're shocked. Very seldom when they buy it do they think they're paying 4 or 5% for their investment product. What they think they're buying is a comprehensive investment solution that'll work in all markets. When we explain to them how a 4 or 5% expense charge works against them in the investment world, they begin to understand why it is their investments can't make any money. So when an investor is buying an annuity, they should be doing it for a very specific purpose. Something they really need in their portfolio that their portfolio can't live without. Right? And that has to be clearly understood at the very beginning when they buy it. To us, it's very important that when you buy an investment, you know up front exactly how that investment is supposed to work. How does it fit in your investment portfolio? What is it supposed to provide for you? When you know that up front, it's very easy to look back 5 years or 10 years after you purchase it and determine, did that product, did that investment actually do what it was supposed to do? Did it provide the results in your portfolio that we needed when we put it in there at the very beginning?